Long-term care insurance business tax advantages. If you're a business owner, then there are valuable tax deductions and advantages associated with long-term care insurance for you and your spouse. Tax-qualified long-term care insurance premiums are treated like health insurance for the self-employed health insurance tax deduction. Self-employed individuals can deduct up to the age-based eligible long-term care premium table. The portion of the premiums above the eligible premiums amount is not deductible as a medical expense. The terms self-employed include the following: sole proprietors, partners, greater than 2% shareholder employees with S corps, or limited liability corporation members are all taxed as if these are self-employed entities. This tax deduction is above the line on Form 1040 Schedule 1, line 16, as part of the self-employed health insurance deduction. Itemization and the 7.5% of adjusted gross income threshold are not required like they are for an individual. Let's look at an example of how this works. Linda, age 64, owns a sole proprietorship marketing business. Her long-term care insurance premium is $4,300 per year. Based on the age-based eligible premiums chart, in 2021, Linda is eligible to deduct up to $4,520. This means she can deduct her entire $4,300 premium. If Linda were 58 years old, she could only deduct $1,690 for 2021. The deduction is not only available for the business owner, but it's also available to their spouse. In our example, Linda's husband would qualify for his own age-based eligible premium deduction amount based on his age. If you're self-employed, you cannot deduct premiums during any month when you or your spouse are eligible to participate in a plan where the employer pays all or part of the premiums for long-term care insurance. Sole proprietors. A sole proprietor does not have to pay the premiums through the business. They can pay the premium personally and take the self-employed health insurance age-based eligible premium deduction. If the premium is paid by the sole proprietorship, the owner must take the total premium paid as a draw. If you're an S corporation, shareholder employees should have the business pay the premium and add the total premium paid to their W-2 compensation. For tax purposes, this ensures the individual's plan is considered an employer plan. If the premium is paid personally instead through the business, it gets a little more complicated. It must be reimbursed with a written agreement for the plan to be deductible as an employer plan on the owner's individual tax return. Partnerships. A partner does not have to pay premiums through the partnership. Instead, if the policy is in your name and you pay the premiums yourself, the partnership must reimburse you and report the premiums as guaranteed payments. You'll take the self-employed health insurance age-based eligible premium deduction. If the premium is paid by the partnership, the premium paid must be added to the partner's K-1 as a guaranteed payment. C corporations. Premium payments are 100% deductible from the corporate tax return as a reasonable and necessary business expense. The deduction is not limited to the age-based eligible premiums. These are treated like traditional health and accident insurance premiums. This applies to shareholder W-2 employees, their spouses, and dependents, and all coverages paid by the business for employees. Employer-paid long-term care insurance is excludable from an employee's gross income, including a shareholder employee's income, and the benefits are received tax-free. To be deductible, C Corp paid premiums must be a 100% corporate expense. They are excluded from the shareholder employee's incomes, bonus, expense accounts, and any other compensation. Non-owner employees. Premiums paid by any business entity for a non-owner employee and spouse are 100% deductible without any limits. They are considered a reasonable and necessary business expense like health insurance premiums. Employer-paid long-term care insurance is not included in the employee's gross income, and the benefits are received tax-free. You can use a limited pay option like a 10-pay that provides a higher tax deduction for the corporation. This allows the policy to be fully paid up in a shorter amount of time with no ongoing premiums required. If you have key people in your business, this is an excellent way to encourage them to remain with your company or even to attract new talent. Taxability of benefits. Another advantage of long-term care insurance premiums is the taxability of benefits received. If benefits are considered reimbursement, then they are 100% tax-free. If benefits are considered indemnity or cash, they are tax-free up to $400 per day, which is $12,167 per month in 2021. If the benefit is more than $400 a day, the excess is taxable unless an equal amount of paid care expenses above that $400 a day can be proven. These are guidelines, and you should consult with your CPA or tax advisor for advice regarding your own tax situation and the status of your long-term care premiums and benefits. I'm Kelly Augsperger, certified long-term care insurance specialist with Steadfast Insurance. If you have any questions or want to learn more, connect with me online or give me a call, and I'm happy to help.